What if I told you there's a way to invest that doesn't stress you out, doesn't rely on hype, and actually helps you pay your bills every month in real cash? This isn't about chasing the next 10 times stock. It's not about meme coins or market timing. It's about something far more powerful and, honestly, underrated. It's about building real, passive income, the kind that keeps coming in even when markets are shaky or the Fed stays silent. So stay till the end, because we'll also break down whether OUE Commercial REIT fits this peaceful investing approach. If you believe more Singaporeans should hear real, down-to-earth investing advice, please like this video, subscribe to Wealth for You, and share it with someone who needs financial clarity. And just to be clear, this video is for education and sharing purposes only. It's not financial advice. Always do your own research or speak to a licensed professional before making investment decisions. Chapter 1. What is investing really? Let's be honest. When people say investing, what comes to mind? For some, it's chasing hot stocks. For others, it's trying to time the market, hoping to catch the next tech rocket or crypto moonshot. But real investing? The kind that builds wealth quietly and reliably? It's about putting your money to work, so it earns more money while you sleep. You're not betting, you're building. While some people hope stock prices go up, the investor we're learning from today focuses on something even more powerful: consistent income from strong cash-generating businesses. Not hope, not hype, just steady cash flow, month after month, year after year. Because when your investments pay you, not the other way around, that's real freedom. Chapter 2. Why REITs are great for income investors. In Singapore, where real estate is a national obsession, REITs, real estate investment trusts, are one of the smartest ways to grow passive income without actually becoming a landlord. Here's how it works. REITs own income-producing properties, like shopping malls, Grade A office towers, hospitals, logistics hubs, and even hotels. Think places like Vivo City, One Raffles Place, or Hilton Orchard. These properties earn rental income. And when you buy into a REIT, you're not just holding a stock, you're owning a slice of the rental income, which gets paid out to you regularly as dividends. You don't chase tenants, you don't repair leaking toilets, you don't worry about property taxes or stamp duties. You just collect income. Simple, scalable, sustainable. And here's the best part. Because REITs are required by law to pay out at least 90% of their taxable income, they're built to reward income investors like us. For Singaporeans looking to build wealth steadily, whether for retirement, CPF supplementation, or just peace of mind, REITs offer a powerful combination of regular payouts, real tangible assets, and zero landlord stress. It's passive income with real-world backing. Chapter 3. The Calm Investor's Philosophy: Income over Hype. In a world obsessed with the next hot stock, one timeless philosophy quietly stands apart. Focus on income, not excitement. This approach isn't loud. It doesn't chase headlines, but it works, especially for Singaporeans who want peace of mind, stability, and passive income that actually pays the bills. Here's the foundation behind this resilient mindset. 1. Prioritize reliable income, not exciting growth. Forget the hype stocks. Forget the overnight success stories. Real wealth comes from predictable, recurring income, not hoping your shares moon tomorrow. If money is hard to make it hard to lose. That means choosing investments that are real, backed by hard assets or strong cash flow, and boring, in the best possible way. Because when your investments pay you every few months, you stop checking prices every day. You just collect, quietly, consistently. 2. Dividends are the ultimate reality check. Dividends aren't some nice bonus, they are the goal. Because any company can tell a good story. But only profitable, well-managed businesses can afford to pay you cold, hard cash, regularly. But not all dividends are good. Ask yourself, are they covered by earnings or real cash flow? Is the company borrowing to pay you? Red flag. Is the yield too high to be true? A good income stock doesn't just pay, it pays sustainably. 3. Diversify, even if you love the stock. One of the most dangerous mistakes investors make? Putting everything into one stock, even a strong one. It only takes one surprise, one bad quarter, one policy change, one scandal, for everything to collapse. Set a rule. No single investment should take up more than 20% of your entire portfolio. Even giants like Tesla, Alibaba, or CDL can crash. 100% in one stock equals 100% stress. 4. Always have an emergency fund. Sounds boring, right? But this is where many fall. Without an emergency fund, one medical bill or job loss could force you to sell your investments at the worst possible time. Having 3 to 6 months of expenses in safe, liquid cash means you can breathe. You can ride out storms. You stay in control. This isn't playing it safe. This is playing it smart. If you want to build long-term wealth, if you want investing to bring you peace, not panic, and if you want to stop depending on market luck, then this philosophy is your roadmap. Chapter 4. Why this philosophy works best in uncertain times. Let's face it, uncertainty is the new normal. Markets are swinging wildly. Inflation is sticky. Interest rates are giving everyone a headache. And just this week, U.S. Federal Reserve Chair Jerome Powell said absolutely nothing about interest rate cuts. No roadmap, no signals, just silence. Meanwhile, everyone's left guessing. Will rates drop soon? Will inflation flare up again? Should I buy now or wait? This is exactly the kind of noise that derails emotional investors. But if you're investing for income, you don't need to play that game. You're not hoping for headlines. You're collecting paychecks from real businesses, backed by real cash flow. Think of it like owning a copy shop. People come in, you serve your copy. They pay. Whether the news is good or bad, you keep earning. That's what income investing is like. You get paid, rain or shine, interest rate hike or cut. Because honestly, when markets are shaky, the most comforting thing isn't stock tips. It's dividends flowing in like clockwork. When you focus on income, you stop guessing where the market is going. You stop stressing over Jerome Powell's every word. And you start building true financial resilience. In an unpredictable world, income investing is your financial anchor. Chapter 5. What about OUE Commercial REIT? One of you asked. Does OUE Commercial REIT, SGX, TSOU, fit the income investing strategy we've been sharing? Great question, and it's one worth diving into. Let's start with the basics. OUE Commercial REIT isn't some small player on the SGX. With a market capitalization of around 1.5 billion Singapore dollars, this REIT owns flagship commercial and hospitality assets in Singapore, including One Raffles Place, OUE Bayfront, Hilton Singapore Orchard, and Mandarin Gallery. These aren't obscure properties. They sit right in the heart of Singapore's CBD and retail belt. This means location-wise, it's A-plus real estate. Here's how the portfolio breaks down: 50% offices, 33% hospitality, and 17% retail. So while it's technically diversified, it leans quite a bit toward hospitality, which we know can be more volatile, especially when tourism or business travel softens. Looking at the key numbers as of the first quarter of 2025, dividend yield is around 6.9%, pretty decent for income-focused investors. Office occupancy stands at 96.3%, strong and healthy, showing demand for well-located workspaces. Retail occupancy at Mandarin Gallery is 99.5%, very impressive. But here's where things get tricky. Hospitality income has been softening. Hotels, which form a third of the portfolio, have seen recent revenue declines. Distribution per unit, or DPU, dropped from 2.09 cents to 2.06 cents year on year. It's not a collapse, but it's a red flag for income investors. Leverage stands at 40.6%, above the industry average. In today's high-interest rate environment, that's a risk worth noting. Growth pipeline? Silent. There are no upcoming acquisitions or redevelopment plans to spark excitement or boost income. So, how does this all stack up? It's a stable REIT with strong anchor assets and a reasonable yield. But it's also navigating headwinds in its hospitality segment and has limited near-term growth visibility. We will evaluate how it fits the income strategy next. Chapter 6. Does OUE Commercial REIT fit this income strategy? So now that we've gone through the detail, does OUE Commercial REIT really align with the calm, income-first investing approach? Well, it's a mixed bag. On one hand, the REIT does check some important boxes. It owns high-quality, income-generating assets in Singapore's most valuable locations. It continues to pay dividends consistently, and its office and retail spaces are performing well. But dig a little deeper, and there are clear concerns. First, the hospitality segment. Hotels make up a third of the portfolio, and unfortunately that segment has recently shown weakness in revenue and performance. Hospitality is always a bit more unpredictable, and in tough times, it's usually the first to suffer. Second, the debt load. OUE Commercial REIT is carrying leverage of 40.6%, which is above the industry average. That's not ideal in a world where interest rates are high and the US Fed remains vague on rate cuts. Third, the growth story is missing. There's no strong acquisition pipeline, no bold plans for expansion, which means investors can't count on capital appreciation or rising distributions anytime soon. And yes, the DPU has been quietly declining year over year. It's not a collapse, but when you're building an income portfolio, you want income that grows, not shrinks. So where does that leave us? If you're someone who already owns this REIT and can stomach the risks, it might still offer decent payouts, for now. But if you're just starting out, or aiming for a defensive, low-stress income portfolio, you might want to explore stronger REITs with lower debt, more stable earnings, and clearer growth prospects. Bottom line, OUE Commercial REIT isn't terrible, but it's not the poster child for income-first investing either. Stay mindful, stay diversified, and always match your investments with your own peace-of-mind priorities. Final thoughts. Let's bring it all together. Investing doesn't have to be stressful. You don't need to time the market. You don't have to chase the next hype stock or crypto coin. If your goal is steady income, peace of mind, and long-term financial freedom, then this calm, dividend-first philosophy, built on real income, not speculation, is something worth sticking to. Because you're not just growing wealth, you're building stability, you're building freedom. One dividend payout at a time. Before you go, if you found this video helpful, do me a quick favor. Like this video so the YouTube algorithm shows it to more Singaporeans who want clarity, not chaos. Share it with a friend, or even your parents, because financial peace of mind is for everyone. Subscribe to Wealth for You, and tap the notification bell so you never miss another calm, easy-to-understand investing guide. And remember this. In a world full of stock tips, hype coins, and endless guessing about what Jerome Powell might say next, passive income is quiet power. It's not just about being rich on paper. It's about being cash flow rich, where your investments pay you month after month. Not someday, but today. If a steady investor can build that kind of life, so can you. Thanks for watching. And until next time, take care and happy investing.